Good evening. Welcome to today's lecture. Welcome to the second half of the semester. So before we start, a few things on the lecture itself. So you might have seen that I have uploaded the grades for the first home assignment. The quiz was before the break. So now you find both the grades and also the solutions for quiz and home assignment online on Canvas. So this means if you have any questions on your mark assigned or on the solution, don't hesitate to approach me. We can clarify everything, but better do it sooner than later, before the next home assignment, in the best case. Okay, and just to give an overview on where we are in the lecture. So I just opened the slide from slides which I have presented in the very first lecture. So you have now submitted the first home assignment. This means the next assignment will be the second home assignment, which will be due in like 2 weeks, a bit more than 2 weeks. This means I will upload it sometime next week. I will inform you. You will see this. You have more than 1 week time to solve it. No need to do anything now. And just that you have an overview on where we are. And the next quiz will be in April. So really the next thing will be the home assignment, uploaded sometime next week. And then you have more than 1 week time to solve it. And content-wise, where we are, okay, scroll in the wrong direction. So this was the overview I've given in the first lecture. And we were discussing in the first half of the semester these topics, which are all related to market risk in a certain sense. So you have seen how to measure, how to quantify, how to manage the risk that is inherent in markets and caused by, certain market variables that move in an unfavorable way. So this was the main topic of the first half of the lecture. And you see there's a structural break, not only a time break, which was last week, but also a structural break, because now, today, we are starting with something new, which will be credit risk. And this will be the topic for the next 4 lectures. So this means today will be like a soft start into the second half of the semester, because I first need to introduce what credit risk actually is and how we can approach this, how we can measure it actually. So this will be the topic of today's lecture. And then in the next lectures, I didn't specify this in this overview, but we will deal with more sophisticated topics related to credit risk. Okay, so this means today's topic will be what I call here credit risk 1, and which actually is an introduction to the topic of credit risk. Good, so the more precise outline will be this. So first I will present you the idea, why it is important to measure credit risk, what we are interested in to measure, and why we have to deal with that. And one very important quantity that you will encounter all the time, that is like the fundamental quantity in credit risk, is default probability. So how likely it is that a certain counterparty will default in a given time frame. And it's not clear how to define these. There are different approaches, and it's actually really not trivial. So we will discuss mainly 2 different approaches how to infer, how to get those default probabilities. And then the second half of the lecture will be, once we have the default probabilities, how we can use them in order to measure certain quantities that are important to measure credit risk. So one ingredient will be default probabilities, and then the next one will be the exposure. So this is the quantity we are prone to lose. And then the next one will be recovery rates. So on a high level, this just means we don't lose everything, but there will be some ratio that we are able to recover. This is the recovery rates. And then in the end, we will see our first approach, putting everything together, measuring credit losses on a portfolio level. Okay, so this is the rough overview on today's lecture. Good. So I want to start with a motivating example, something which I could have presented already in the first lecture, or let's say at least in the third lecture, when we were discussing interest rates in the context of market risk. So what we have here is an OTC, so over-the-counter contract. Over-the-counter, again, means that two counterparties deal directly with each other. There's no central clearinghouse. There's no guarantee what happens in the case of a default. So that's very important. So I trade with you, and the deal we have is that you pay me the difference between 2% and some reference interest rate, which is SORA in this case. So this is the Singaporean. You could say the Singaporean version of SOFR, so some overnight funding rate. We have discussed this in lecture 3, so you can really think of this without specifying all the details. Some overnight interest rate, and so the deal here, the contract, pays the difference between the two. So one is the fixed leg, this is the 2%, and the other is the SORA. So this means I get 2%, I have to pay the SORA. So this means it is favorable for me if SORA is not high. So this means I make a profit whenever SORA is below 2%. And this, you look at the payoff diagram here, and everything is linear, right? So the higher SORA, the more I profit in a linear way, or in the case, it's just in the other way. If I'm looking from the point of view of my perspective, once having entered a deal, a lower level of SORA is beneficial for me in a linear way. If I would swap the perspective, looking at everything from the other counterparty, the diagram would just swap. Okay, so this is the payoff profile. And I now could, this is what I could have done in the first part of the lecture. I now could ask the question, what would be the present value of this risky instrument, of this contract? And now you start to think about this. You have learned a lot about risk neutral valuation. You want to understand the payoff. The payoff is not too complicated. Again, it's linear because you just fix one side and look at how the reference interest rate evolves. So what you want to do is to look to compute somehow the expected value of the payoff and then determine the present value. But what you ignore when you do that is really what I mentioned earlier, that that each of the counterparties can default. So you don't get your payoff in the case of a default of the counterparty. So this means if we look at this case, so this means we look now at a very high payoff, which happens in the case, for example, here, if SORA is very, very low, this means actually you consider a difference between 2% and a very small level of SORA. The diagram tells you, okay, you get something close to 2%, and if the notional would be $1 million, you multiply everything with $1 million. But if the counterparty defaults, you don't get this, right? So this is being ignored in this diagram at all. So we don't consider this here, but this is exactly what we now, when we talk about credit risk, which we want to take into account. And in order to take this into account, we need to answer a couple of questions. So the first one would be, how likely it actually is that we don't get our money back, right? So how likely it is that the counterparty defaults? Because this is certainly an important quantity in order to determine the present value of this contract. So that's the first question. Because we only get our cash flow when the issuer does not default. So therefore, we want to just measure the event of default, which also determines the event of no default. The second question would be, Okay, what is the current value? So this is very similar to the consideration without default. So we want to determine the value of the exposure, so the size of the value of the contract, which we are prone to lose in the case of a default. Well, that's called the exposure at default. So that's really like the amount we are losing in the worst case. And then, if there's a default of the counterparty, typically you don't lose everything. You are able to recover some part of the contract value. This is simply because if there is a default of the counterparty, there's still some value, right? So there's still money available, not the whole amount, but you get something back from the contract typically. You can think, we specify this later, but you can think of some value around typically 50% or something like that, depending on a lot of things. This is called the recovery rate. So what you are able to recover in the case of a default of the counterparty. Okay, this is just a motivation to tell you that these diagrams, typically you have seen a lot of them already, are not telling the whole story, right? Because they are ignoring exactly these considerations that this is only true in the case that the counterparty does not default. Good, but we want to do everything on a bit more sophisticated level. We want to take this into account. And in order to do this, we need to answer these three questions. And mathematically, what we need to define for this is really, all the ingredients we need to model the default of a counterparty. This will be first the default indicator. So this is something that is binary. That's just telling you whether there is a default or not. So this means default indicator just means 1 if there is a default, 0 otherwise. So it's actually quite simple to understand quantity. Nevertheless, it's very, very hard to define the precise distribution of this thing, right? You are not able to tell this a priori without any considerations how to define this random indicator, because still this is a random variable, even though the distribution is quite simple. This depends a lot on a precise modeling on the default event. The next quantity is the loss given default. So this is the ratio of the whole exposure you have that you are losing in the case of a default. That's just like the opposite quantity that I was telling you about earlier. This means this would be 1 minus the recovery rate. So it's just changing the perspective. Now we are interested in the losses, so therefore we are changing the perspective. We are not interested in what we recover, but we are interested in what we lose. So therefore we are looking at everything from a loss level. This is the loss given default. And the last quantity are the exposures. So again, this just means, again, from a loss perspective, we are looking at things. The quantity we are losing in the case of a counterparty default. What this means, if our exposure would be negative, this just means that in the case of a counterparty default, nothing happens, since this means from an economic perspective that that the counterparty is having a claim against us. So therefore, there's no loss, but a gain in the case of counterparty default. So this is not what we are considering. We are really looking at positive exposures. I will specify this later exactly. So it's not just looking at the value, but we need to distinguish the cases of positive and negative exposures here. Okay, and we are interested in these quantities for everything we are invested in, right? Because we have a lot of counterparties, we have a lot of positions, we have a lot of risks. There are also correlations between different defaults and so on. So we want to, in the end, the goal will be to define some notion of credit risk loss based on a construction on these three main ingredients. Okay. That's what we are interested in. And before we come back to this, I want to talk a bit about how, in practice, with credit risk is dealt. So one of the main innovations in the last, 30 years now, it is already well established, are credit derivatives. And this is because people have realized, okay, there's a lot of credit risk in the financial market, and therefore people and financial institutions found it very attractive to invest in credit derivatives, mainly because they allow to manage and transfer the risk, the credit risk actually, that is inherent in financial products. So the most popular and prime example of a credit derivative is a so-called credit default swap. We talk about the details in one of the next lectures. A credit default swap is just something like an insurance against a default of a counterparty. If you invest in something like that, if you have an insurance against a default, then you are hedging the credit risk that you are exposed to when you enter an OTC contract with a credit with a counterparty. Think of the very first slide. Right? So that's hedging the risk. You need to pay a premium for that. Nothing is for free, but you can do that. You can hedge your risk and transfer the risk to someone else. In this case, this would be the issuer of the credit default swap. Okay, so this means if you issue, on the other hand, from the other perspective, if you issue a credit default swap, you're taking the risk, right? So you're a risk taker. On the other hand, if you hedge, you are giving the risk away. So that's one, and I would say the main motivation for credit derivatives. But of course, if you are not invested in, for example, the OTC derivative that I was telling you about earlier, you can also just speculate, right? You can speculate, for example, that there will be no default. You can issue a CDS, take the premium, and if there's no default, your speculation was successful. You have pocketed in your premium, for example. Something like that, you can do that. So this means you can also trade, of course, in credit derivatives without any hedging incentive. And the third motivation would be regulation. We have talked a bit about, when I was explaining financial crises, a bit about CDOs. And CDOs are basically just packing loans, packing debts, and converting them to securities you can trade in. And loans are subject to credit risk from the perspective of regulation. So this means the regulation framework considers loans as credit risk. Whereas CDOs are securities which are subject to market risk. So this means different regulation requirements are applicable to these instruments, even though the underlying risk is exactly the same. This means in this case, it was possible, now it is no more, but it was possible back in 2008 to do something that is called regulatory arbitrage, which just means that you need to reserve less capital for the risk you're taking. Now, there's still incentive in, so we talk about regulation in more details, as I have already promised a couple of times in lecture 11 and lecture 12, but keep this in mind. And the second component here would be that if you're investing in CDS instrument, credit default swaps, for hedging purposes, then this reduces the regulatory capital you need to hold. So this means there's really an incentive to reduce your risk, not only from a risk perspective, but also from a regulation perspective. It just means you need to hold less capital, and holding less capital means you can invest your capital. This is what typically financial institutions want to do. Okay, so these are the main motivations, and therefore credit derivatives are, I mean, even though they started to trade only like 30 years ago, they are super popular now. And I mean, if you look, for example, in Singapore for quant shops and so on, so most of them are in credit risk. I don't know if you've realized that. Okay. And the products that are mainly traded are, I mean, you can consider simply any derivative, any security that is traded between two counterparties as a credit derivative, right? Because, I mean, in any of those instruments, what you have is the component that the counterparty may default. So, for example, you can construct strategies of two instruments, one being traded on an exchange, where you actually have no credit risk because of central clearing houses, and the same kind of instrument OTC traded and profit from a default, right? So in that case, via this kind of indirect strategy, you can profit from defaults or speculate from defaults. So because there is always like default risk inherent in any OTC traded instruments between counterparties, any, what I write here, vulnerable security can be considered as a credit derivative. So this might not be what you think of as a credit derivative, but you can consider them as credit derivatives, simply because they depend on the default of a counterparty. The second is the more classical example. So simply credit derivatives that directly from the structure of the payoff of what they pay out, it's directly visible that they depend on the default of a counterparty. So the prime example would be a CDS, credit default swap, which I mentioned earlier. So which is some kind of credit insurance. You need to pay a premium on a regular basis, and in the case of a default of a counterparty, you get a large notional amount. That's what you can think of. And there are other types of credit derivatives, and you typically distinguish between single name credit derivatives, so which are written on one underlying security, one underlying counterparty, and also multi-name credit derivatives, which are taking a whole basket of securities, a whole basket of counterparties. So for example, there are derivatives that pay out if the first, I don't know, if you have 1,000 counterparties, if the first 10 default or something like that. And also part of this portfolio derivatives is the case of a CDO. CDOs collateralized debt obligations. I mean, we have discussed these in detail in lecture 2. You have the basket of loans, you have the cash flows, right, and different seniorities in different tranches, and you get your return only if, if you are senior enough in your tranche, and if not, let's say not all of the less senior cash flows default, something like that. You remember this waterfall structure. This is also a portfolio credit derivative. Good. But again, the prime example, if someone asks you what is an example for a credit derivative, which you should keep in mind, probably will be a CDS. Yeah. Coming back to the default event, so this is what actually we are interested in to model. The default will be a discrete state. It's actually, in the simplest version, just 0 or 1, right? It's binary. Either there is a default or there's no default. Sometimes it's not that easy, right? Mathematically, it's that easy, but sometimes there is a dispute between the counterparties, whether there is a default or not. There can be a delay in payments and so on. So then the counterparties argues, okay, there was a default, and blah, 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 these kind of things. So in order to avoid these legal insecurities, there is a precise legal framework with the intention to avoid exactly these legal arguments. And this is, you've seen this before, this is the ISDA framework that specifies exactly what defines a credit event. What does it mean that there is a default? What does it mean that there is a default which triggers then, for example, the payment of a CDS? So this is very important that you have a precise definition of a default event. Okay, so this is what we will use. If there's a default according to ISDA, our discrete state will be 1, otherwise it's 0. That's what you can think of. It does not mean that the counterparty is completely bankrupt. It just means that, more or less, that there is some financial distress, there can be some delay in payments, and so on and so on. And whether you get your money back from the security you are invested in depends on your seniority. Seniority means you can think again of the CDO example from lecture 2, waterfall structure. If a lot of counterparties default in the basket and you are super senior, you're not affected at all by this. But this really depends on how senior your investment actually is with respect to the whole basket that is subject to defaults of the respective counterparties. Okay, so this should motivate what we are doing, and now we're starting to define things a bit more precisely by looking at actual default probabilities. Okay, so what we want to define is the probability of default. This means how likely it is that a counterparty defaults in a certain time frame. And for this, there are mainly two different approaches. So the first is called the actuarial approach. And this corresponds to looking at things under the historical measure. And I write here down under P, right? So what you should have in mind is, and you are familiar with this from option valuation, from looking at things from the perspective of stochastic analysis, looking at everything from a historical measure point of view. This means what we do here is really to look at historical default data. How likely was it that in a statistical sense, historically, a counterparty with these and these properties has defaulted? This gives you some measure P, and then under this measure P, you try to measure the probability of default. The second approach, and now you know what I write down, right, would be Q. So this is market price methods. So what you are doing is you look at traded credit derivatives, at traded products that depend on the default of a counterparty, and try to use this information in order to infer the probability of a default under the measure Q. So that's basically the idea of the second approach. And the main difference between those two, so they are not the same, that's very important, they are not the same. The first approach, the P approach, is by construction, how I define this, a backward-looking approach. You're taking historical data, construct your measure P, and all you do is really looking at what happened before today. In the second approach, what you are doing is you look at credit derivatives, and credit derivatives have a maturity in the future. So they tell you something about expectations of the market in the future. Tell you something about expectations of a default in the future. So the difference is really the perspective. In the first approach, you're looking at the history. In the second approach, you are really looking into the future. Okay, so forward-looking versus backward-looking. So we start with the P approach. So I should have denoted it here, but yeah, you know I've defined this. So this is the actuarial approach to measuring default risk. Actuarial, again, would be the P approach, so taking historical data. And this is something you might have seen before if you observe financial news and so on. So this is actually what rating agencies are doing, right? So rating agencies, there are three major rating agencies in the US. There's Moody's, S&P, and Fitch. And they assign credit ratings to, I mean, actually any financial institution that is issuing something that is traded on financial markets. And the ratings they assign depend on, I mean, it's not clearly specified. So that it's not like, so this is something I need to mention. So it's not like a formula you can apply. There's no closed form formula, closed form solution or anything like that the rating agencies are using. They just tell basically that the rating they assign depends on different things, and the different things are, I mean, they are looking at the company has different characteristics, and based on these characteristics, it falls into a certain category. The certain category has historical default rates. This means a company in this category has defaulted with a probability of 1% within 10 years or something like that. And then they use, I mean, some statistical techniques in order to infer the corresponding rates. So you need to approximate, you need to smooth, and so on, whatever. But this is roughly what they are doing without disclosing exactly what they are doing. So you just mention it's an opinion, right? It's not like a statistical technique or something like that. It's an opinion. It's the agency's opinion on the future ability, legal obligation, and willingness of an issuer of a bond or other obligor to make full and timely payments on principal and interest due to investors. Okay, so here we are talking mainly about bond investments. Okay, so this is what we should keep in mind. But still, this is typically, if we are talking about historical default probabilities, actuarial default probabilities, what we are thinking of. The default probabilities that are based on exactly the opinions of rating agencies. Okay, and this is more precisely how this looks like. There are different categories. So, you know, there are AAA rated instruments, AAA rated counterparties. AAA is typically the best rating, the highest grade. Then you remove 1A, you get AA. That's a bit worse, but still good. And then A is also a bit worse than AA, but still investment grade. So this means still something you consider safe, and so on. You go down to BBB, BB, B, CCC. And CCC is actually speculation. Why is this speculation? Because now you look at the PD range. PD stands for probability of default within 1 year. And historically, in this category, so S&P is publishing this data. I'll show you later how this exactly looks like. So historically, over the range of a bit more than 40 years, the data is from last year's report, so taking into account default rates until 24. If you have a rating worse than CCC, the probability of a default within 1 year is larger than 1/4. That's quite high, right? So it's a very high probability that you lose at least a part of your money. And in contrast, if you are invested in a AAA instrument, the historical default rate is 0%. And so on and so on. So you see here the different ranges. So you see, okay, for until, I mean, everything that is investment grade has a PD range of smaller than 0.2%, so quite small, but still present default probabilities, but small default probabilities. That's why we call them investment grades. And then it increases to non-negligible numbers like 25% in the case of CCC and worse. Okay, so this is what the rating agencies are doing. And now we want to define these things in a mathematical manner, what we are talking about. So we are not talking about how the rating agencies are getting their ratings, but we are talking about how to define default probabilities simply in a mathematical manner. And this is important because there are different notions of default probabilities. And the first one would be the marginal probability of default. So marginal means really that we are looking at a default in a specific year. Okay, precisely what we are doing is we are looking at the proportion of issuers. So you see here we are looking at a specific rating category R. This can be, for example, AA, something like that. So we have different categories. Now I just use a placeholder R. And what we are interested in is the marginal probability. So we are looking at this number MTR. So these are the issuers that are in this category at the end of the period divided by and that have defaulted by the end of the year, right? Relative to the remaining number at the beginning of the year. So we want to measure how many of the constituents of this category default within the period from t-1 to t, and for this we just divide mt by nt. So this means if we want to measure really the relative number of how many have defaulted within that time frame. Okay, this is what we call a marginal probability, because we are not comparing against how many were initially in that category, but we are really looking at how many are there at the beginning of the period. So this means at time t-1. This is what we denote by nt. And then how many remain at the end of the period, which is mt. This is what we typically denote by pdt. So here you see the time index t, R is the category, and mathematically this is a conditional probability. So we look at the conditional probability of the default at the end of the period, given that some obligor was solvent, so was still alive at the beginning of the period. Okay, the next quantity we need here is the survival rate. So we want to measure how many of the issuers have not defaulted by a certain point of time. It's denoted by ST. And how do we get that? We simply multiply 1 minus PD. Again, PDI would be the marginal default probability defined in the first bullet point here. 1 minus PDI gives you the probability of not defaulting, of surviving over the period. And then given you have survived period 1, we multiply with the probability of surviving the next period and so on. Why is this exactly the quantity we are looking for? Because by definition, what we want to measure is the probability of surviving until time t in this case. This is what the index t tells you. This means the probability of being solvent at time t. Okay, and being solvent at time t implies that I was already solvent at time t minus 1. Right? So this means if I intersect with the event of being solvent at time t minus 1, the probability doesn't change. Good. And now what I can do is I can also write this as a conditional probability. And just applying, if you want to call this Bayes rule, right? So just definition of conditional probability. So I get probability of being solvent at time t, conditional, and I condition here on the on being solvent at time t minus 1 times the probability of the condition, which is being solvent at time t minus 1. And this is the same as now I look at the counter event, which is being in default at time t. So this means I have here 1 minus probability of at default at time t when I was still alive at time t minus 1. So solvent at t minus 1 times the probability of solvent at t minus 1, which is s t minus 1. And what is standing here, probability of default at time t given solvent at time t minus 1 is exactly the probability, the marginal probability of default, PD. So what I have here is PD T of R. Okay, and I get this recursive formula, right? So ST relates to ST minus 1. I just need to multiply this with 1 minus PDT. And now I can inductively apply this formula, and I get just the product that you see here. But that's the formal derivation of this formula. And intuitively, it's just like, you're just looking at surviving a certain period, multiplying with surviving the next period, and so on and so on. And this gives you the overall survival rate. Okay, so we have defined these two quantities. And before we continue defining two more quantities, just want to give you, as you have seen that, I think you were expecting this, one small example to get familiar with these quantities. Okay, so here we would have we would have 100 borrowers, and we assume that in the at the beginning of year t, so this means at time t minus 1, 50 are still there, so 50 are solvent. Okay, and then we assume that in the next year, between t minus 1 and t, additionally 5 default. Okay, and what we want to compute is the marginal probability of default, so the first quantity, and the second would be the survival rate. So take a time to think about these. Look at the definitions that I've presented on the slides. I mean, you have the slides. Different options. I mean, what you need to do for the first quantity, for the probability of default, is really to think, okay, you know 5 default. So the question is, to which denominator do you need to relate these 5 defaulters? And then you get your PD. And for the second quantity, the survival rate, it's very similar. You just need to look at how many have survived at the beginning of the period and then multiply with how many survive within the next time frame. Or from another perspective, 1 minus how many default. Okay, this looks quite good. Seems that you know what to do. That's very good. So this means okay. Okay, so yeah. Let's just explain this example, right? So in the example I was mentioning, if we have st minus 1 being 50, and we also have that n empty in this notation would be 5. So these are the additional 5 defaulters. And we have being solvent at the beginning of time t is also n. So this is the same notation here. So it's n t being 50. This means if I compute this PD in this case, I just omit the R for simplicity, but I mean, just laziness here, but I mean, you know what I'm doing because I didn't specify the rating category, actually. What I need to compute is just 5 divided by 50, and I get 0.1, right? This is the first example, and the survival rate here with these numbers from the example would be, I mean, just applying this induction is, I think, the easiest way to compute this. So what I need to do is I need to multiply 1 minus 0.1, right, which is the PD, which I have computed here, times ST, which is 50. So I have 0.9 times 50, which gives me 45%. So this is in percent numbers. Or, yeah, so 55, depends on whether you want to look at the number of defaulters or everything in percent. So you get 45 remaining borrowers at the end of the period, which is time t. Okay, and this is exactly what you have seen here. Okay, and so this was the conditional marginal probability, and the next step would be to consider everything unconditional. What this means, I mean, now you've understood how things work in a conditional manner. So the idea is exactly to set everything relative to the people being alive at the beginning of the period. And in unconditional manner, this just means you consider the number of people having defaulted in the certain period relative to your initial number of borrowers. Not at the beginning of the period, but at time 0. So that's the difference. So here it is written out. So the proportion of issuers that have your rating R that default in year t. So this means in year t means between time t minus 1 and t relative to the initial number of issuers. So that's the important difference. So now you relate everything to how many borrowers you have started with. So in the example, it was 100. And yeah, and so this means formally you divide by a different denominator, right? Instead of 50 in the previous numerical example, you now divide by 100. And how you define this is the number kt. So you look first at how many have survived until t minus 1, and then multiply with those that default in the next period. So this is your marginal default probability. This means you have this additional factor st minus 1 in front of it. Okay. So in the, maybe coming back to the numerical example, this would just mean that KT would be, we had 50 times the marginal probability of default was 10. So this means we get just 5%. Okay, instead of 10%, right? In percent. Good. So this is the unconditional marginal default probability, and the next step would be to look at the overall numbers. So we now know how many default within the specific periods, and what we are also interested in is the, it's just summing up those that have already defaulted by time t, and this leads to the cumulative default rate for the whole time period from 0 to t, denoted by CT, where you just sum up the unconditional marginal default probabilities, which is the same as considering 1 minus ST. ST, again, is the survival rate until time t. Then you can define this. But before I continue, maybe I'm not sure whether this equality is clear. It might make sense on an intuitive level, but let me just explain this a second. So what we have is, I again omit the dependence on R, but just for notational simplicity. So 1 minus ST is the same as 1 minus, and here we had 1 minus PDT times ST minus 1. So this was the recursion we have seen earlier, right? So when we want to compute ST, what we can do is we can just look at the product over all the 1 minus PDs, and we have derived this using this recursion. If you now write this down and simplify this, you get 1 minus ST minus 1 plus PDT times ST minus 1. And PDT times ST minus 1, just look at the definition of the unconditional marginal default probability, it's just KT. So we again have some kind of recursion. So we have 1 minus ST minus 1 plus KT. And you can play the same game again, right? So you get 1 minus ST minus 2 plus, and so on, KT minus 1 plus KT. And you do this t times, and then you have 1 minus S0 plus K1 until KT, and S0 is just those that are solvent at time 0, which is 100%, so this is 0. So you really have K1 plus, so you sum over all the KIs, which is exactly what is standing here. Just to explain this equation in a precise way, but on a high level, it's clear that this makes sense. You just sum over all those the default in a specific period, and nothing is relative. Everything is absolute. You just compare, again, this is the definition of the KIs, the defaulters with those that were initially there. So summing up those just give you those that have survived, that have defaulted, which is 1 minus the survivors. Okay, and here the last equality. So you see here, it's just a definition actually. I could also write this as a definition of what is standing on the right-hand side, because what is standing on the right-hand side does not depend on I anymore. Just some approach to average over the PDs. So the PDIs typically will not be the same in every period of time. They might be different. But typically you want to simplify this approach a bit and just boil this down to one quantity, one probability of default in a 1 year time frame to assume some kind of homogeneous structure. So it means the probability of default over 1 year should not depend on whether the period starts in 5 years or in 10 years or today. And in order to achieve this, you just define an average probability of default in this way, by just assuming the same PD being applied to each factor, and then you get what is standing on the right-hand side. This is the average per period default rate. And if you don't see a time index with the PD, this is always what is meant. Good. Another example to get familiar with these quantities, if we have a default rate in the first year of 1.4%, in the second year 2.3%, you see the default rates are, not 0, right? So this corresponds typically to something like a BB rated company. But doesn't matter for the math, but yeah, to get some economic intuition, you see here they are larger than 1%, so they are not investment grade anymore. In the first year, we can compute the unconditional default probability in a very, very easy way, but just, the unconditional default probability in the first year just coincides with the conditional default probabilities, because the number of survivors in the beginning is just 100%. So this means the denominator for both computations is the same, and K1 is the same as PD1, which is provided to be 1.4%. S1, the survival rate is 1 minus 1.4%, 98.6%. And then in the second year, K2, the unconditional default probability, so you're really looking at how many default in that specific period relative to the initial number of issuers in that category. And for this, you need to multiply S1 with PD2, and S1 was computed in the first step, and you get a slightly smaller number than 2.3%, which is 2.27%. And then you can use those quantities in order to compute the survival probability to survive until time 2. So this is 1 minus PD1 times 1 minus PD2 by definition of S2, and you get the probability of surviving until time 2 would be 96.33%. This implies that the probability of defaulting until time 2 would be 1 minus this probability, or you can also get this by summing up the unconditional probabilities of default. So this is K1 and K2, and this is 3.67%. Good. Okay, so this is quite simple so far, because what we did was just to say there are only 2 states in this world. Either you are alive or you are dead. Either you are solvent or you are in default. Either 0 or 1, right? But the real world is a bit more complicated, because think of what I've shown you earlier. There are also states in between, so you can. It makes a difference whether you are AAA or AA, or even worse, CCC or something like that. So this means there is something in between being perfectly solvent and in default. So there are grades in between. Okay, and we want to get there. And to develop some mathematical framework to get there. Okay, so, and in order to achieve this, we typically work with a Markovian framework using transition matrices. The transition matrices tell you how the evolution of the underlying process goes from one state to another. In the case of two states, this is very simple. It just means how likely it is to go from being alive to being dead. Because once you are dead, you cannot get alive. There's no resurrection or nothing like that, right? You're not Jesus. So this is not possible. So this, in that case, it's very simple. But in the case of having more states, it's a bit more sophisticated, and you need transition matrices that tell you how to transition from one state to another. Okay, in the two-state case, it's also possible to do this. And to this end, you just define the transition matrix that looks like this. So you have two states, either being solvent or default, and the matrix tells you how likely it is to transition from one state to another or to stay in the current state. So there are four possibilities. The first one would be to be solvent and to remain solvent in the subsequent period. The probability is 1 minus PD. You default with probability PD, so this means you stay solvent with probability 1 minus PD. Exactly the second possibility is being solvent and default. The probability is PD. Being in default and becoming solvent, again, this is the Jesus thing, it's not possible. And being in default is therefore what we call an absorbing state. So once you are in default, you stay in default forever. Probability is 1. Okay, and how we can extend this to several states is what we see after a short break of 5–10 minutes. Okay, let's continue. So, yeah, the last thing we have seen before the break was that we can understand the two-state case where we only consider really default or not default also as some Markov process. So this means everything only depends on the current state you are in, and if there are only two states, so this means everything that matters is how likely it is that you transition to the other state, and if one of those is absorbing, the only thing that really matters is how likely it is that you switch from being solvent to being default, which is the absorbing state. And this leads to this default, this transition matrix that you see here. And now we want to extend this in a natural way to what you expect, to the case of having multiple more granular states. So this means some of these intermediate possibilities, some states being in between being dead or alive, right? Which correspond to different ratings you can assign to different issuers of instruments. And in the general case, we can have K non-default states, R1 and RK, so different categories. You can think of AAA, AA, and so on, these different ratings. So we have K of those, and we have in total K plus 1 states, because additionally we have the default states. Right? So you can transition between the different states. You can transition from AAA to AA, from AA to AAA, and all the other states, and so on. And also one possibility is always to directly default, which is still an absorbing state, still no resurrection. So this means this is a special state because of this feature of being absorbing. And the corresponding transition matrix then looks like this. So we have all the columns from R1 to RK and being default, and different rows, same as a symmetric matrix. So up to the default state. And no, sorry, forget, it's not symmetric because Pij is not Pji. As the meaning of Pij, which are the entries of the matrix, are the probability of being of starting in state I. So we condition on state I at the beginning of the period and making the transition to state J at the end of the period. This means there's a conditional probability of being in state J at the end of the period, given that we have started at state I at period Tn. So if you now consider one of the rows, let's say we look at the first row here as an example. P11 just means that we start in state 1, so the first rating, and stay in the rating, in this rating category at the end of the period. So we don't move, we don't leave our rating category, we remain there. That's everything you see on the diagonal. So P11, P22, and so on. These probabilities always mean that you don't change your rating category. Okay, and the next one would be P12. This means you make the transition to a worse rating. You transition from rating category 1 to category 2, and so on. And the last one would be to go in default when initially having been in category 1. And what always needs to be the case is that those probabilities sum up to 1. Right? Pik summing over the case always needs to be 1. And here I'm including the default probability, so I'm summing to k plus 1. So what I mean here is this is the summation, to be more precise, over the Pik plus the corresponding default state, right? So this is the k plus first state. So those need to sum up to 1, because those are the conditional probabilities which always sum up to 1. And this is the corresponding transition matrix that tells you the probabilities of transitioning from state I to state j within one period. Okay, and this also only tells you what happens within one period. Now, I mean, typical example would be this is a 1 year period for default. It's very typical that you consider default probabilities for 1 year, but you might be interested in, let's say, 5-year default probability. This can be relevant because, I don't know, you are looking at future outcomes of your payments which are due in 5 years instead of 1 year, right? So, but you want to know how likely it is that the counterparty defaults within 5 years or within 2 years or something like that. And the question is, how can you infer those long-term probabilities from only having one shorter period? And this is very simple if you assume a Markovian structure. So Markovian, again, means that everything only depends on the current state, but not on the history having observed. So not on the rating history, but only on the current history. If you have that, then the 2-period transition probability, so the notation would be with the superindex 2, can be obtained by summing over pik, where we sum over the case, times pkj. So this means pik corresponds to, looking at row I times column j. So we just look at this, just some matrix multiplication. Okay, why is this true? Why is this true? Pij2. So what it means, what it should mean, is that this is the probability of being in state j after 2 periods when initially having started in state I. So this means state j at time 2 at t being 2, given state I at time 0. Right? So this just corresponds to the to this definition here. But now I'm just skipping the intermediate step. This is what it means. I consider everything over 2 periods. And if I write this out, I'm just using if I look at this equation, all I can do is actually just to apply the definition of the conditional probability, right? So this means to write it as an intersection divided by the probability of the condition. And then what I get is this probability of state j at time 2. And here I'm intersecting with state I at time 0. And I'm dividing with the probability, of state I at time 0. So this is very boring. It's just the definition of the conditional expectation. But now what I can do is I can look at all the possibilities for the intermediate step, right? So what can happen after one time step? This means I look at being in state k at time 1, and if I intersect with this and sum over all the possibilities, then this equality is true. Just intersecting with the whole space, that's all I'm doing. So here I'm intersecting with being in state k at time 1, and I'm summing over all the possible states. Good. Let me call this star. And Now I can, just go the way back. This means instead of writing this as an intersection of different events, I can write this as a conditional probability. And what I have then is the probability of being in state J at time 2. And here I'm conditioning now on a different thing, because now I'm conditioning compared to the first line, because I'm conditioning on being in state K at time 1 and being in state I at time 0. And if I do this, this is not correct unless I multiply with the event I condition on. So I need to multiply with the probability of being in state K at time 1, state I at time 0. And I still need to multiply with, divide with the denominator I have here. So which is the probability of being in state I at time 0. Okay, and here I told you what I need to assume, but I guess it was not clear for you why I need to assume this, but now it becomes visible that everything is Markovian. Right? So that everything only depends on the current state we are in and not on the history. And formally this means, if I look at this first conditional probability you see here, it actually doesn't matter that I was in state I at time 0. The only thing that matters, if I look at the condition, is that I'm at time 1 in state K, but not the previous history. It doesn't matter. This is exactly what it means to be Markovian. So this means what I can do is I can ignore this part of the condition if I assume that things are Markovian. And then what stands there is the probability of being in state J at time 2 when I was in state K at time 1. And this is just a one time step transition probability. This is what I have called PKJ. The second part I could also write as a conditional probability, right? So this is the probability of state K at time 1, conditional on state I at time 0. And this is the same as PIK. And this is exactly what is standing here. And this is the matrix multiplication. So this just tells you that if you want to look at the two-step transition probability, all you need to do is to consider the power of the matrix, everything to the power 2. And by induction, if you want to consider everything for n periods, all you need to do is to consider everything to the power n. And to the power, I mean matrix multiplication. Okay. And so an important thing I have assumed here, maybe I should mention this. So we assume that everything is Markovian, and this was assumed in this step under Markovianity assumption. So two things, right? So the transition from state at time 1, between time 1 and time 2 is the same as the transition between time 0 and time 1, and everything does not depend on the history. Okay, let's look at an example. It's a bit simplified example. So we have 3 ratings, A, B, C. And this is a kind of typical transition matrix, right? Because the diagonal typically composes or consists of the largest probabilities. So it's always the largest probability to stay in the rating category that you are currently in. That's also what we see here. And the default probability is, if A is the best rating category, is the smallest for A and the largest for, the worst rating category, which is C in this case. Good. And what we are now interested in is, this is a 1-year matrix, 1 period transition matrix, and we are interested in calculating the default probability over 2 years. Okay, and initially the company is B rated. So this means what can happen for the company is that it can either default directly, which happens with probability of 1%, or it can switch to one of the 3 categories and then default in the 2nd year. Right? This means either stay in category B or switch to A or C and then default in the 2nd year. So these are the possibilities we have to consider. The first case would be really a default in the 1st year, happens with, according to the matrix, with probability of 1%. This is what is exactly standing here. The second case would be, there are different paths, 3 possible paths. So the first one would be make the transition to A and then default. The default from category A has a probability of 0. So this means this path has a probability of 0 in total if you multiply. The second path would be to stay first in category B and then default. Probability is 0.94%. And the second path, second possibility, second non-zero possibility of defaulting after having survived the first period would be to first transition to C and then default. This happens with probability of 0.45%. And for this, you just multiply the corresponding probability of the transition in the first period with the probability of making the default in the 2nd period. And then you sum those up, and you get a default probability of a bit more than 2%. So this is something you can always do, but this is a bit complicated. This is not what I advise you to do, because you really have to think of all the possibilities that can lead to a default. But according to what I've shown you earlier, what you also can do, just look at the power, in this case the second power, so the square of the transition matrix, and then directly look at the corresponding entry that you are interested in. In this case, this is the square of the matrix. This gives you directly the 2-year transition probabilities, and then you can directly look at this entry, because this entry tells you the probability of starting in category B and defaulting in 2 years, right? And if you think about how this is actually computed, it's just a summation over all the possibilities. It's exactly what is standing here, but directly being done and being expressed with these numbers. And if you are interested in how likely it is that you stay exactly in the same category B after 2 years, then this number is what you're looking for, and so on and so on. So this is exactly telling you what is happening over the 2-year period. Okay, and so everything is still historical, right? So these are the actuarial probabilities. Before we start talking about the Q probabilities, I just briefly want to show you. I've also uploaded this to Canvas. So there's a document which is issued by yearly by S&P, and they publish these transition probabilities. So they also publish the corresponding default rates and everything. So it's quite an interesting document. So I advise you to have a look there. And if you go to page 50 of the document, so then you see how these transition matrices look using real data. So they have different considerations. So they look at transitions on a global basis, also for the US market, European market, and so on. And here you see the real numbers. So you see exactly what I have told you about earlier. So the diagonal typically consists of the largest probabilities. Here you see the true default numbers, default probabilities, and so on. So this is really the 24 default probabilities transition matrix. Then you have also average transition matrices, and so on and so on. So if you want to have a closer look at how those things look in reality, I advise you to have a look at this document that I have provided you. Okay, and this is, as I mentioned, everything is under P. So everything here is under the historical measure, because the idea is that S&P is looking at historical data, is estimating their default probabilities, is estimating the transition matrices, and so on. And everything is backward looking. And the next step would be to talk about how things change when we look at things under the measure Q, so which is the forward-looking market implied measure. Good. For this, we need to have some information on prices of default from the market, so to say. And for this, we need to have some market instrument that is subject to default risk. We start talking about a corporate bond, but I mean, this can also be another instrument. The most important thing is that here the feature is that the instrument we consider is subject to default risk. Okay. We typically talk about bonds, but also will consider different instruments. And the reason why we consider bonds here is simply because they have this very simple payoff structure. They just make a single payment in the case of a zero coupon bond, or just a cash flow of deterministic payments. Okay, and here we say we have a single payment of 200 euros in 1 year. Then what you can do, and I've explained this in every detail in lecture 3, right, that you can infer the yield of this instrument by just looking at the price, P, whatever the price is, the market tells you, and discounting the notional with the yield. Okay, and in the case of a zero coupon bond, this would just correspond to the corresponding continuous interest rate, right? Okay, but now what we want to assume is that the situation is slightly different, because the payment we receive here is no more deterministic, right? I mean, if you have a corporate bond, this always means there is the possibility that this company that is issuing the bond is defaulting before maturity, and this just means that you don't get your notional entirely back. Instead of getting everything back, in the case of a default, what you get back is only a part of it. Formalized, this would be 200 euros times R. R is the recovery rate, so R is some number between 0 and 1. It can be deterministic, but typically it's not. It's something that is being determined in the case of a default. So it's also a random variable that depends on a lot of things, depends on the evolution of the market, and so on and so on. Okay, so this is the situation we are facing. Two cases: if there's default, everything is as usual. If there's no default, everything is as usual. But if there's a default, you only get 200 times R back. And here we make, and I'm not happy about this, but this is a convention, we make a slight abuse of notation, because we also write PD. As in the case of the P default probabilities, we also write PD. But what we mean here is something different, right? We mean the default probability under the measure Q that is inferred from the market. But convention is that in most cases it's clear what situation you are facing, and therefore you just write PD for simplicity. Okay, so PD here means the risk neutral default probability, again, under the measure Q over the 1 year period. Okay, these are the two cases. So either there's a default happening with probability PD. In that case, you get only R times your notional back, or if there's no default happening with probability 1 minus PD, you get the entire payoff back. Good. And the question now is, how can we use this framework to get information on PD? For this, we first need to understand how the price of the bond is computed when things are no more deterministic. Because, in the deterministic case, it's very clear. You get always your cash flows, you just discount them, sum them up, and that's it. But again, if we are taking defaults into account, it's unclear whether the default happens or not. Things are stochastic. And if you have a stochastic payoff, what you need to apply is risk-neutral valuation. This is always what you can do. So this means if we are in this situation that we are facing here, the price, I denoted by P, can be computed as the expected value under Q. I want to use the same notation for the interest rate, so I use discounting with the, R0 just means risk-free interest rate with maturity T times payoff. That's roughly the structure. And the payoff here depends really on in which case we are, right? In the first case, it's R times 200. In the second case, it's 200. This means we have two different situations. So we discount the payoff, which is binary. So in the first situation, we have, let's start with no default case. So indicator, if there is no default, well, that's a random event. And in that case, we get 200. In the case of a default, so you see these events are exclusive. Only one of the cases is happening at each time. We get R times 200. So that's the payoff we are facing. Okay, so, and the first indicator function can also be written slightly different in terms of the second indicator function, right? So if the first indicator function is 1, then the second is 0, and vice versa. So this means the first indicator function is just 1 minus the second indicator function. So we have here 1 minus indicator function of a default, just because they are exclusive events. And also, all the quantities are deterministic. The only one that is not deterministic is really the indicator function. Everything else, 200 is a deterministic number, the discounting factor here is deterministic, and so on. This means all I need to compute is the expected value of a default. And the expected value of an indicator function, we have seen this already several times, is just the probability of the event. This means what I will get here is the following. So we have e to the power minus RT times 1 minus, and the expected value of this is the probability of this. Probability of default is PD. PD times 200, so maybe, plus PD times R times 200. Yeah. Here, PD times R times 200. So this is what I get if I write the price out. Okay. And this is standing here on the right-hand side. Okay. And I just wanted to explain this a bit more in detail, because this is quite important in terms of a concept. So the right-hand side is just a valuation of the bond when taking default risk into account. What you see on the left-hand side is the approach using directly the yield of this bond. So assuming that P is some price and you compute the yield of this. And very important to note is now that in this framework, the yield is not the same as the interest rate, right? Exactly because of the second component, because of PD not being 0. Good. And now what you can do, you want to derive the PD somehow. That's the goal. That's what I promised you. You want to derive the PD somehow from the price of the bond that you observe in the market, or from the yield you observe in the market. Yield and price are 1-to-1, are more or less the same. So the 200 doesn't matter. 200 is standing on the left-hand side, is standing on the right-hand side. I can cancel out the 200. It really doesn't matter. Then I solve for the PD, which is standing on the right-hand side. So the right-hand side, of course, can be simplified a bit. And what I get is what is standing here. It's just really solving this equation on the right-hand side for PD. Okay. And this equation here tells you that you can get the probability of default. Again, this is the probability of default under Q from the quantities that are standing on the right-hand side. Here I'm assuming that R is a deterministic number. So you could also consider here the expected recovery rate. But for now, we assume that the recovery rate is just a fixed number. And you can get this actually from the yield. Good. And now what we can do is we can set the yield to be, the yield, of course, because you account for the possibility of default, should be larger for bonds that are subject to default risk. So you want to get compensated for investing into something that is risky, right? You would get a yield of R0 if there's no default risk, but if there is additional default risk, what you should get as a yield is something on top of R0. And this on top is called a spread. This is S0. So this means what we define is the yield of this risky bond to be R0. So this is something like the baseline, what you always get if you invest in a bond. And the S0 quantity is giving some additional compensation for investing in this bond. So this means what we see here in the exponent is the difference between R0 and the yield, which is just a spread. This is S0t. Okay, and if you invert this formula, you get also just one-line equation for the spread, independence of the default probability. Good. Okay, so this is true in if you are looking at just one period, and the possibilities are that you default in this period, you don't default in that period, and the bond pays out at the end of this one period. Okay, and so what you see is from these considerations that we're starting with this equation. The price of the bond can be written as, and it's just an assumption, just a definition of the yield, as the discounted value of the nominal where I discount with the yield. Good. And if I write the yield in terms of the spread, then this just tells you that the value of the bond can be written as e to the power minus r plus spread. It's just writing the same thing, either in terms of the yield or in terms of the discount factor plus spread. So just what I mentioned earlier, you can no more discount just with the interest rate, but you have to really put something on top of the interest rate that compensates you for taking the risk of investing something that is risky. Okay, and this factor here that you see in this greenish color, that is what we call the corresponding credit risky discount factor. So it's not just a discount factor, but really the discount factor is taking the credit risk into account. Okay, and this is the baseline consideration, and now you can start to extend this to multiple periods. So one extension would be to say, okay, the bond expires in 2 years instead of 1 year from now. And the possibilities, then, I mean, you just get more possibilities of a default. And what you also do is you, instead of distinguishing between different marginal probabilities of default, PD1, PD2, and so on, you just take, typically for convenience, average annual default probabilities into account. So you don't see an index 1 or 2 with the PDs anymore, right? You just see PD. And the same equation as before, basically, the price of the bond would be, again, just discounted with the yield, the nominal value, 200. And the price is being computed on the right-hand side. So the first possibility is, so to say, to survive the 2 periods, which is 1 minus PD to the power 2. Right? So this is just surviving until, in this case, year 2, T2 being 2. The second possibility is not surviving until T being 2. This means going into default earlier than, or latest at time 2. So there are different possibilities, but you can easily compute this probability by just saying, okay, it's 1 minus surviving. So this is just 1 minus the survival probability. So this means defaulting before T2. Okay, and then similarly you can, rearrange these equations, and what you see is that, if you compound with the interest rate, it's the same as compounding with the yield, but then you have to multiply this with some factor that is smaller than 1. And depends crucially on the recovery rate. If the recovery rate is 1, this is the same, this is just 1, but recovery rate is typically smaller than 1. And this factor is just telling you how much the yield is actually larger than the risk-free rate. Good. And so straightforward extension of the 1 period consideration is illustrated here. So possibility of a default in the first period with probability PD or no default. So this means surviving the first period. And then, everything is homogeneous. Therefore, we consider PD, not PD1 and PD2. So just an average default probability. And the payoff we get is in both cases R times the nominal if we default, and if we don't default until maturity, we get the nominal back of 200 euros. And we made a small simplification here, right? I don't know if you've realized, but if you look at the payoff in the second case, we assume here that there is some default before year 2. It can happen, after 1 month, for example, or after 2 months, or it can happen after 2 years. But there is some default before T2, but we discount what we get with the with R0 times T2, so with 2 years discounting. So this means we implicitly assume that we get the money back, R times 200, after 2 years, even if the default is much earlier. So of course you can extend this and also account for a more sophisticated structure by assuming it's different when you default earlier, you get your money back earlier, and so on. So there are different extensions possible. If in the case of a default in the first period, so first period means between time 0 and time 1, if then the payments, so R times 200, are already made after 1 year, then you need to discount, of course, with the corresponding discount factor T1, right? So you just need to look at the different cases when the default happens. So this corresponds to default in 0, 1, and this here corresponds to default in the second period. The probability for this would be surviving the first period, which is 1 minus PD, times defaulting in the second period. So the unconditional default probability, 1 minus PD times PD. Okay, in both cases you get R times 200, but the discount factor needs to be different because you get the money back at different points in time. And the first component is still the same. Okay, and now similar to what we did in the case of interest rates, you can also apply some bootstrapping approach to get the marginal probabilities of default. As I mentioned, in the pricing approaches you have seen here typically assume that the PDs do not depend on the time indices. Right? So it's just PD, it's not PDI. And you can, however, infer the marginal probabilities of default, so the PDIs, from these pricing formulas. So how would you do that? So this is the relation you assume for averaging here. 1 minus PD to the power T is just the product of the difference 1 minus PDIs. So this was also what I mentioned earlier when I was defining the survival probabilities. And so you would think of bootstrapping for interest rates. You start always with the shortest maturities. So this means you start with PD1. So this means we get PD1 from price of bond with maturity 1 year. So this means in that structure, if you have the price of bond with maturity 1 year, PD corresponds to PD1, because the right-hand side of the equation you see here, it's just one factor, and PD corresponds to PD1. And in the second step, what you do is you compute PD for bond with maturity 2 years. And here PD, not PD1 or PD2. So this means exactly look at this pricing formula. For example, if you assume to distinguish between first period and second period defaults, then you get your PD from the price P. Okay, and once you have PD1 and PD, what you can do is you can use 1 minus PD2 being 1 minus PD1 times 1 minus PD2. And PD1 is known, PD on the left-hand side is also known. You can solve for PD2, right? And this is again, the same principle as for interest rates. You start with the short maturities and then extend the longer maturities by extrapolation. Okay, just maybe. Yeah, so these are mainly the two approaches. So there's default probability under P, default probability under Q. One is forward-looking, one is backward-looking. And the difference is really that one is inferred from market prices, whereas the other is inferred using statistical methods or believing in the rating agency's opinion, right? But anyway, it's based on historical data. And therefore, by construction, they cannot be the same. And to understand this, I mean, we consider something that is called a yield spread. And I want to illustrate this using an easy numerical example. So we have two instruments. One is considered risk-free, which is a US Treasury bill. So again, governments are typically assumed to be risk-free because they are able to print their own money if they have danger of going into default. So US Treasury bill is considered to be risk-free, zero coupon bond maturing in 1 year. And as a second instrument, we have the same kind of instrument, but a different issuer, which would be a company, which is well-rated, A-rated, but not default-free. Okay, and the yield for the US instrument is 0.31%, and for the A-rated company is a bit higher, again, compensating for taking the risk, 0.4%. Then we need to make an assumption, the recovery rate, let's say it's 45%, and we want to infer the implied default probabilities. So what we can do is we can apply the Formula 1. Formula 1 is this one, equation 1, I should say, not Formula 1, equation 1. So this means we have what is standing on the right-hand side. R0 is the yield of the risk-free bond. Y0 is the yield of the risky bond, and from the difference, which is the spread, we can directly get what is standing on the left-hand side, which is the default probability. Okay, if we apply this formula, plug in the numbers, then we get a default probability of 0.16%. Okay, and now what you can do is you can compare this number with what I have presented to you earlier, which is the default probability of an A-rated company, according to the tables from S&P, right? And then you see, okay, that actually in this table, the default probability should not be higher than 0.06%, but it is higher. Why is this the case? Because this 0.16 you see here is the default probability under Q. Even though my notation doesn't tell this, right? Again, it's not a good notation, but it's the standard notation. So PD is PD, independent of whether it's under P or under Q. So the PD here is under Q, it's 0.16%, but the S&P table, which is at most 0.06, is under P. That's the difference here. Okay, and the explanation is that a large part of the credit spread, the credit spread is the difference between these two numbers here, S0, is some kind of risk premium. So what you get as a compensation for investing in something that is risky. So if you assume that 6 basis points are of this 9 basis points spread are a risk premium, this means you lower the spread accordingly to 0.34% and then redo the calculation, then the right-hand side would yield 0.054%. Now this means that there's really some component of the spread that tells you something about the difference between actuarial rates, the rates under P, and the risk neutral rates. And this chunk can be understood as some kind of risk premium. In this case, in this numerical example, it's roughly something like 6 basis points. Okay, this is what we call a risk premium. So it's the difference between the bond's market implied and actuarial default probability, between the PD under Q and PD under P. Again, you need to get this, otherwise there's no incentive for you to invest into risky instruments. Typically, investors are risk averse, and without this risk premium, no one would invest. And this is incorporated in the risk neutral PDs, and it's very hard to define general rules for this risk premium. It depends on a lot of things. Actually, this depends on the market price of the instrument, right? And the market price of the instrument depends on a lot of things. Depends in particular on the liquidity of the instrument. So how large is the offer? How liquidly the instrument is being traded? How risk averse people are? How is the financial situation overall, right? If there's a financial crisis caused by CDOs or something like that, of course, people become more risk averse. You need to get more compensation for trading in risky instruments, and so on and so on. And last but not least, typically transaction costs, tax effects, and so on. Okay, and so we have these two approaches, and now, the last question would be that you could ask me, what should I use, actually? Should I use the PD or the QPD, the actuarial or the risk neutral PD? And my answer is, it depends completely on what you want to do, right? So the answer on a high level is the same as for valuation. So for valuation, you are only using the Q measure whenever you want to evaluate a financial instrument, right? Otherwise, the correct answer is always to use P. So this means if you want to, even if you are forward-looking, for example, you want to do a scenario analysis for future possible defaults, this does not mean that you need to use the forward-looking measure Q, because the forward-looking measure Q should only be used for valuation, because this is some kind of artificial measure that is being used for pricing instruments and does not tell you something about actual default probabilities. So this means, coming down to the precise application we have here, if you want to price, if you want to hedge, so everything that you also know from valuation of equity instruments, you need to use the risk neutral default probabilities. Otherwise, for all other applications, in particular for future scenario analysis, in order to calculate how much capital you need to reserve, risk charges and these kind of things, you should use P. So for this case Q, and for the other cases, you need to use the P measure. Okay, let's do another 5 minutes break and then conclude with the last part of today's lecture. Okay, maybe let's slowly start with this question. So, suppose that you are looking at some investment and the payoff is negative for you, right? What does this mean if the counterparty defaults? Is this good for you or is this bad for you? Just a very simple but very important consideration, actually. Okay. It seems that most of you get it right, even though it's quite late, so that's good. I need to think a moment for this, but yeah, you're on the right track. So if the counterparty defaults in this case, this just basically means that, I mean, more or less, you don't have to. I mean, it doesn't affect your losses at all, right? It affects the. It helps you in the sense that you don't need to pay your obligations. And this is very important for the definition of credit exposure. So the credit exposure is defined as the cost of replacing the financial instrument at the time of a default, at the time a default of the counterparty happens. And a loss is being considered as a claim against the defaulted counterparty. And therefore, if you look at this definition, the current exposure of a contract at time t should only take into account the positive part of the value of the instrument you are considering. So again, so what you got right, according to the poll, if the value is negative, this is no exposure that is causing losses to you. So therefore, the exposure that is relevant, the credit exposure for losses, is only looking at the positive part of the value. Okay, and so this is one component of the definition, and the other component or dimension of this definition is the time of default, right? So this means here the time t is unclear. I just defined the exposure here at some future time t, but actually what you are interested in is the exposure at the time when it becomes relevant, which is the time of a default. And this is a random time in the future, so therefore you are interested in the exposure at default. So the exposure at default would be the exposure at time tau, where tau corresponds to default time. And you see this from the notation. There's a stopping time or some unknown time in the future, right? And anytime we are talking about exposures in the future, exposures at some time t, it can be the time of at default, or it can be just some future time. It always includes some uncertainty with respect to the evolution of the future value of the underlying instrument. And whenever we want to emphasize this, we are talking about potential exposure, right? So, I mean, this is, by definition, the exposure is a random variable, but if we want to quantify this by either taking into account, you will see examples in a second. For example, you could think about taking the expected value of this, you could think about computing the value at risk of this, and so on. Then we are talking about potential exposures in the future. Okay, so what are more precise examples of exposures? So if we are talking about loans, so this means if I lend money to someone, then the exposure is just like the size of the loan, more or less. So this is the risk I'm exposed to. This is by definition a positive number. So if I consider the maximum of the nominal and zero, I mean, up to discounting, this is exactly what what the value will be. For a swap contract, you're exchanging a fixed against a floating premium. This is very hard to tell in advance because this is subject to randomness in the future, whether the value at a future time will be positive or negative. Think of the example I was mentioning in the beginning. Some interest rate, SOFR or something else against a fixed leg. This depends completely on whether the floating leg is larger than the fixed quantity you exchange at. So this means it can be positive, it can be negative. If it's positive, this means you have a claim against the counterparty. If it's negative, actually the counterparty would have a claim against you. This means if the counterparty defaults, nothing happens at least to your losses. For options, if you're long into an option, this means you can exercise the option. You're an option holder. In that case, you have a claim against the counterparty. This means in that case, the exposure would be, if you're in the money, at least positive, otherwise at least non-negative after having paid the premium. If you're short your option seller, this means you are short the option, and in that case, the counterparty could have a claim against you. But again, the overall, you cut at 0, and therefore the exposure would be 0 as well. So these are typical cases and very, very simple considerations. So again, you want to look at the loss side of things, and therefore the definition of the exposure would be whatever is larger, the value, or 0. Okay, and the potential exposure. So this involves the uncertainty of how the exposure evolves in the future. In particular, this involves the evolution of the value of the instrument in the future. And how can you do this? How can you calculate this? You could set up some stochastic model. You could do simulation studies and so on. So some way to simulate the value of your instrument in the future. Typically, this involves modeling the underlying risk factors. So in equity markets, you are experts now. You could set up a Black-Scholes model or something like that. You could also set up some historical simulation approach and so on. But these kind of things that involve modeling the risk factors that are relevant for the valuation of the instrument. And then it depends really on, also what kind of model you're using here, what kind of modeling approach. Depends what your definition of potential exposure is, because there are more or less two important quantities. The expected credit exposure is just the expected value, and the worst credit exposure, which is the valued risk. And for the valued risk, you've learned, how to compute this, and before the semester break, again, you could use some historical simulation approach or something like that. Okay, for the precise definition for the expected credit exposure would be just to look at the, FT being the density function of the replacement value, of the asset value, so of VT. So this means what we have here is nothing else but the expected value of whatever is larger, the value of the instrument, and 0. So here there's no uncertainty with respect to the time, so I fix the target time, target date t. That's the expected credit exposure. Quite simple, just to say the potential exposure is the unknown exposure at some time t, and I take the expected value of that. This gives me some quantity that I can measure. The next one would be to just look at the valued risk of the exposure. So this tells you something about what can happen in the worst case. So if the counterparty defaults and your exposure is very high, and let's say in a 99% quantile way, very high, what kind of loss you can suffer. This is exactly what the worst case credit exposure tells you, WCE. Definition is exactly the definition of the value at risk at some confidence level alpha. So here we are looking at a tail, but I mean, this is the same as looking at the CDF if you are more convenient with this notation. So it's the same as to say the probability of the exposure being smaller equal than Z being greater or equal than alpha. So this is exactly the same, right? So still the smallest Z value so that this is larger than alpha. So this is exactly the same. Just by subtracting -1 on both left-hand side, right-hand side, and multiplying with -1, you get this equation. And then, I mean, we have seen this for continuous, just a reminder actually for lecture 5, when you have a continuous random variable, all you need to do is to solve for this equation. It's just solving the CDF being alpha. I mean, this is the same using this equation here. So the first definition of the value at risk as alpha being minus infinity to WCE, FDX, dx. So which is the same as the probability of VT0 being smaller or equal than WCE, right? Okay, and you just solve for WCE and then you get what you want. So it's just computation of the value at risk. And then the last thing would be the exposure at default. Exposure at default, by definition, you now have the additional component, additional dimension of not knowing the time of the exposure. And that's just the definition of what we are looking at here. And in the case of a loan, we are typically decomposing the exposure further into two components. So the first would be the outstandings. So that's what we already have lent to the obligor, to the borrower. So, I mean, which is already away in the case of default. And typically you also make commitments to the obligor, right? So you promise to, I mean, I lend you additional money in the future, and so on and so on. And what typically happens in the case of a default is that just before a default, let's say 1 day before a default, the defaulting company is trying to get additional money, so it's drawing the commitments to get additional money. So it's very likely that out of the commitments, a large ratio will be drawn by the obligor. This means you really have the two components. So the first is the outstanding, so that's the exposure which is already away, and the second part would be the commitments. And out of the commitments, typically not everything is away, but a large part, which is denoted by gamma, so gamma being some number between 0 and 1, will also be lent to the obligor, to the borrower, just before the default. So therefore, you have the outstanding plus gamma times commitment decomposition of the exposure at default. Okay. So in the last part of the components of modeling credit risk is the recovery rates. Recovery rate, again, a number between 0 and 1, percentage number, a fraction of the exposure that you can recover in the case of a default. So typically not all the money is gone if there's a default, but you get something back. And the recovery rate is exactly the ratio that you get back. Describes the uncertainty about how severe the loss actually is. If the recovery rate is 0, I mean, it's very severe, you don't get anything back. Recovery rate is 1, means you get everything back. There's actually no loss. These are the extreme cases, and there's just some measure of everything in between these cases. Okay, and I mean, to understand this, the toy example you should have in mind is really a bit like the waterfall structure of the CDO. Everything depends on the seniority. So now you have an understanding of seniority. So seniority just is some ordering of who gets the money back first in the case of default. So in the case of the CDO, this is, I mean, this is a feature of the instrument, more or less. If you're more senior invested, then you get your money back first, or you're not affected by the defaults in the first place. And this is very similar for all kinds of instruments. There's always some thing that is called pecking order, and that is defining who gets the money back first. And this is also effectively like determining the corresponding recovery rate. So the more senior you are, the higher your recovery rate. And the loss given default is the same quantity. The only thing is that we look at the same thing from a loss perspective. So LGD is just 1 minus recovery rate. Yeah. It just tells you what you don't get back is a loss, but it's the same thing. It's a loss given default. And yeah, I mean, S&P and all those rating agencies, they also publish like typical recovery rates. So if you're interested, I'm pretty sure in the document I've uploaded, there are also recovery rates inside. So for typical rating classes and so on, for classes of that, what you typically get back. And just that you have some numbers in mind. So if you have just bonds, corporate debt, typically recovery rates are a bit less than 50%. I mean, of course, there are other secured debt types, or I mean, there are also like certain banks which have, how to say, a more senior position in the pecking order. So there are these, these development banks, for example, which invest in infrastructure in poor countries. They have typically recovery rates of 90% or something like that. But for just normal corporate debt, these are the typical numbers you have. Okay, loss given default, as I mentioned, is 1 minus recovery rate. And this just describes everything from the perspective of a loss. But again, mathematically the same quantity in the sense that it's a 1-to-1 relation. And I mean, in the previous example, we assumed just a fixed number. But I mean, if you want to model this more sophistically, more realistically, then you should assume a random variable to model the loss given default. Something like a beta distribution is very often used. I mean, it needs to be some distribution which has only a range between 0 and 1. And there are a couple of candidate distributions. One of them is the beta distribution. Yeah. And for the expected, I mean, very often, we will see this in a second. So you need to define the loss given default. And if the loss given default is just a constant number, because, I mean, one wants to simplify the model, for example, then one just replaces the loss given default by ELGD, the E standing for expected loss given default, just meaning that the loss given default is the same as the expected loss given default, implying that everything is constant, right? So if you see this in the formulas, this just means that the loss given default is constant. Okay, and now we can put everything together in order to define our first approach to model portfolio losses of credit risk. So we have n loans which are subject to credit risk. So you have a portfolio of loans, you have lent money to n obligors, And therefore, what you first do is you consider the loss on a borrower basis. This means for each obligor, for each borrower, you consider the corresponding loss, and the loss is very simple now. The loss is just the exposure at default times the loss given default times dn. dn is a default indicator, so dn is either 0 and 1 or 1. So if there is no default, it's 0. There's no loss. If there's a default, it's 1. And the loss then is EAD times loss given default. EAD, the exposure, and you multiply the exposure with the loss given default. So the fraction you really lose. Okay, so this is the loss on an individual basis, and then you sum simply the losses up to get the portfolio loss. So you sum over the LNs, which are the individual losses, and then you get a portfolio loss L, which does not depend on N anymore, as being the sum over exposure at defaults times loss given defaults times default indicators. And you are now interested in working with this quantity. So this is what you actually want to do. You want to look at the losses and maybe compute things like, I don't know, the value at risk of this, the expected shortfall of this, and to manage the risk of your portfolio you have. This is what you are interested in. Okay, but this is very complicated actually, because if you look at this loss distribution, the DNs are not independent. And this means if one borrower defaults, it's much more likely that another defaults as well. So there is some default correlation between the borrowers. So typically this is a quite complicated because dependent loss distribution. So the individual loss distribution might not be very complicated. But if you aggregate, it can become very, very complicated. So to compute the loss distribution is too complicated for now. So we start with smaller steps for now. So what we instead want to do, just for now, for today, because it's quite late, right? So we just look at the expected and unexpected loss. So next time we do mini steps to approach the problem a bit further, but for now, for today, we just look at expected loss and unexpected loss. And unexpected loss is just the standard deviation of the loss, which also is complicated enough. You will see this in a second. Okay, and quantiles of the loss distribution are then a bigger goal, which we won't touch today in more detail. But later we come back to this problem again. So the expected loss, we start computing this. I mean, things are linear, so therefore it's quite easy to compute the expected loss, right? So the expected loss on an individual basis just means that here you see the notation. Very often you just write letters together to simplify notation and so on. This is just what people in credit risk are doing. So ELN is the expected variable LN, so the expected loss on an obligor basis. And LN is exposure at default times loss given default times default indicator. And therefore, if we actually want to compute this, so going back to here, right? So if we want to compute the expected value of this, EAD typically is a constant value for loans, right? You can assume this more or less. It's just more or less the size of the loan, but LGD and DN are random variables, and they might be dependent. And then it can become very complicated to compute this quantity. So what people in credit risk typically are doing here is to assume that these two quantities are independent, and then you can just write them as a product. For loss given default and default indicator, it's somehow okay to assume this, so that the size of the loss, so the recovery rate or loss given default, does not depend too much, at least, on the default time itself. It's not correct, definitely, but it's a simplification that is typically being done in order to be able to compute something. And if you compute this, then you get what is standing here. So again, this is the expected loss given default times default indicator, and then you're just, factorizing it because you're assuming independence. So you assume that LGD and default event are independent, and then you're summing over the expected losses of the obligors, and you get the expected loss on a portfolio level, which is denoted again by just gluing the two letters together, EL, this S standing here. Good. So the unexpected loss is the standard deviation of the loss. If you already need to make some assumptions for the expected loss to be able to compute something, you won't achieve anything for the unexpected loss without making any assumptions here. So again, we want to assume that DN and LGD are independent. And again, exposure at default would be constant, which is okay typically for loan portfolios. And then what you need to do is you want to compute this quantity. So actually square root, okay, this is easy, but the variance of this quantity. So let's just do this. Variance of exposure at default times loss given default times default indicator. Exposure at default is constant. Okay, it's right here. So we get exposure at default squared times the variance of loss given default times default indicator. So this becomes expected value of loss given default squared times dn squared minus expected value of loss given default times dn squared. Good. And the default indicator is just either 1 or 0. So if you square this quantity, it just remains the same quantity. So nothing happens. This means dn squared is the same as dn. So I can also erase the square at the dn here. And also what I have is that LGD and dn are independent. So this means the expected values of the product are just the products of the expected value. And also if I take the square or something like that, nothing happens. This is the same as the expected value of the loss given default and here I square times the expected value of dn, which is PD. And here I have ELGD square times PDN square. Yeah. Good. And now I'm using this weird definition here. Again, the notation in credit risk is sometimes a bit counterintuitive. So here you have VLGD, but V is not the variance, but the square root of the variance. So variance of the square root of the variance of LGD. And this means what I have here is actually exposure at default squared. And here I have the quantity expected value of the loss given default squared, right? And I want to relate this to the variance of the loss given default. Okay, and the variance is the VLGD squared. So I want to write something like VLGD n squared times PDN. But this is only true if I add ELGD squared times PDN. Okay, so this means I have here plus ELGDN squared PDN minus, and here I just copy ELGDN squared times PDN squared. Okay, and I think now all that's, basically I'm done because I cannot really simplify further. What is standing here is ELGDN squared times, and here I have PDN minus PDN squared. And this is the same that is standing here, right? Taking the square root, and then you get just this unexpected loss. This means in the case of the assumption that LGD and DN are independent, you can at least get some, nice looking formula for computation of the standard deviation. But this is on an obligator basis, so this means we still have the index n. So what we want to do in the next step would be to consider this also on the portfolio level. And then, you're almost lost. So you need to additionally assume more or less that LGDs are constant. So because what you actually want to compute is now the variance of your portfolio loss, and this involves now all the covariances between loss given defaults and loss given defaults times D for the different obligators. And so this becomes very complicated. So what you at least can do is to assume that the LGDs are constant. Then you can write the LGDs in front of the covariance. So LGD n in front of the covariance, LGD k in front of the covariance. And then you only have the covariances between dn and dk. And you can relate this to the correlation between the, this is something you need to know, the default correlation. This is something we definitely should not assume to be zero. Never, 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 right? You can assume maybe the loss given default being independent of the n and so on, but never assume that the default correlations are zero. So this means, again, we want to assume LGDs are constant. So therefore you can write this covariance term here as LGD n times LGD k times the covariance dn dk. And the covariance can now be written, so LGD n times LGD k times, and here we have the correlation between dn dk, but then I need to multiply with the standard deviations. So then I have sigma dn times sigma dk. Okay, and sigma dn, sigma dk. Dn is just actually a Bernoulli variable, being 1 with probability PD. Right? And the variance of this is PD times 1 minus PD. Okay, so this means the standard deviation is the square root of PD times 1 minus PD, one time with the index n and one time with the index k. And so everything more or less depends on the default correlation. So again, this is something you never should assume to be zero. This is very important. All the other assumptions, okay, also not very nice, but you can do that. You can argue, but for the default correlation, better not assume that this is zero. Okay, so I mean, this is all I wanted to tell you about today. I think this is enough. This is just like the toolbox we are now having in order to continue with credit risk in the next lecture. Okay, stop here.